We are looking at a 5-day data set of a day trader's executions. The environment is chaotic, saturated with intersecting trend lines and rapid price fluctuations. When we examine the individual entries, we find textbook candlestick patterns, bullish 180s, tail bars, and color changes occurring alongside a consistent account drawdown. There is an assumption in retail trading that memorizing geometric shapes on a price chart equates to a profitable edge. But a candlestick pattern occurring in a vacuum is merely statistical noise. Executing technical triggers without strict spatial and temporal boundaries creates a system engineered for negative returns. By the final days of this dataset, the trader introduces a strict corrective philosophy to their strategy. Not all money is your money. In practice, this new principle requires actively refusing to interact with the vast majority of intraday price swings. The objective shifts. The goal is no longer to capture every market movement, but to isolate and execute only what they define as an A-plus setup. These specific setups demand the exact alignment of 3 variables: a rigid geometric structure, clear directional momentum, and a specific time of day. In the final days of this log, the frequency of trades drops. The entries that remain are the ones that finally move the equity curve out of the red. Consistent returns are not generated by continuous market interaction. They are extracted by waiting for rare, mathematically quantifiable alignments and exploiting them aggressively. The first filter of the system is the spatial baseline, the 200 simple moving average. This chart highlights a crucial distinction. A diagonal 200 SMA provides almost zero structural support. Price action will slice straight through it. Only a perfectly horizontal, or flat, 200 SMA acts as a high-probability floor. Watch what happens when a specific anomaly interacts with this horizontal line. This is an elephant bar, a massive, high-volume candle with no wicks to the left, launching directly upward off that flat 200 SMA. Together, these form the flat 200 clearance setup. The trader buys at the high of the elephant bar and places a strict stop-loss directly beneath the flat 200. Reviewing the logs from March 24th, this precise configuration yielded the highest reward-to-risk ratio of any trade taken that week. The model then requires a secondary structural boundary, the 20 simple moving average, which dictates immediate directional momentum. The space wedged between the fast 20 moving average and the slow 200 moving average creates a contained spatial zone. When price enters this area, its movement accelerates. These geometric anchors dictate the exact coordinates where executions are allowed. They serve as the primary filter against random price action. The dataset also exposes exactly what happens when those spatial rules are violated. We can see this breakdown clearly in the trader's executions on Uber from the middle of the week. Here, the trader correctly identified bullish reversal patterns, but they repeatedly attempted to buy them while the 20 moving average was sloping steeply downward. The price spikes briefly at the entry points, giving a false signal of success, before aggressive selling pressure resumes. Executing a bullish pattern against immediate bearish momentum places the trader at a mathematical disadvantage. This establishes an absolute rule: never trade against a directional 20 moving average, unless the trade initiates directly off a flat 200 SMA anchor. Contrast those midweek failures on Uber with the successful executions logged on Friday, March 27th, under the ticker MERC. This chart shows the proper technique for entering a directional environment, the color change entry. The trader waits for green candles to pull back upward into the declining 20 moving average, followed by a single red candle. The setup allows counter-trend buying to exhaust itself. When that red candle appears, the trader shorts in the direction of the primary trend, and the price follows through forcefully downward. This specific entry aligns the trader perfectly with the path of least institutional resistance. Fighting immediate momentum degrades probability. Executing in alignment with the 20 moving average turns minor pullbacks into high-yield entries. Even with flawless geometry and correct momentum, an A-plus setup requires a third variable, chronological permission. The validity of market structure decays depending on the exact time of day, regardless of how perfect the visual setup appears. Look at this intraday timeline. Between 11:30 a.m. and roughly 1 p.m., the market enters a temporal window classified as the chop zone. During this window, institutional volume dries up. The market is left in a localized, directionless state. Executing even textbook setups inside this specific window results in tight whipsaws that repeatedly trigger stop losses and bleed capital. This hostile environment contrasts sharply with specific intraday nodes known as major reversal times, namely 10 a.m., 11:15 a.m., and 1:30 p.m. Mapping the dataset's successful countertrend moves reveals a recurring alignment with these temporal nodes, providing the directional follow-through missing from the day trades. A textbook candlestick pattern at 12:15 p.m. often lacks the volume to sustain a move, while that same geometric shape at 1:30 p.m. enters the market as institutional liquidity returns. An A-plus setup is only valid when the spatial architecture is explicitly granted permission by the clock. Comparing the trader's execution early in the week to the streamlined Friday session illustrates the value of these constraints. Left, the early week reality: frantic entries, forced setups, and equity degradation from overtrading the chop zone. Right, Friday. Only 2 precise entries executed flawlessly off A-plus spatial configurations, perfectly aligned with the flat 220 moving average flow. This streamlined approach resulted in maximum profit with minimal exposure to market risk. The transition to positive expectancy resulted from the active omission of subpar data. The trader stopped attempting to master every tick and began ignoring them instead. Professional trading is an exercise in data filtering, not continuous action. The complete framework relies on strict alignment, a flat 200 SMA anchor, momentum matching the 20 SMA, triggered by specific candlestick anomalies, executed strictly outside the chop zone. If price action occurs outside of these rigid parameters, the trader must aggressively ignore it. This requires overcoming the psychological fear of missing out on random, unpredictable market moves that happen in the noise. Success relies on adhering to the mantra, "Not all money is your money." Technical analysis is not a tool used to predict every tick of the market. It is a filter used to identify when probability clearly favors an execution. Long-term profitability requires sitting out the noise. You wait patiently for quantifiable alignments, and you strike aggressively only when the math dictates a definitive edge.